Now that we have tools to determine the price structure of a 1-2 combo, the question now lies on the selection of which wave 3s are worthy to trade. Filtering for relative strength and stock screening has been an age-old problem when trading financial markets. Here in Open Journal, our parsimonious solution consists of two parts: price-based filter and a trend-based filter. A given issue should show a significant strength in momentum compared to its peers, the market, and the main benchmarks. In the investing universe, momentum is defined as the general performance of a given issue. Momentum investing is trading that focuses in strong market trends that already exhibited performance. For example, a stock that returned a more than 100% performance is generally more attractive than ones that are flat, say year to date. The main assumption is that high performing stocks will continue to outperform, while low performing ones will continue to underperform. If we relate this filter to the Elliott wave approach, we like stocks which have a broader baseline and has a higher momentum relative to its peers. The higher the baseline, the larger the runway for the potential wave 3. So it is of our interest to find and scout baselines with broad momentum. Although finding momentum is crucial to our analysis, it is equally important to compare the retracement of potential wave 3s. In the previous video, we learned that the shallower the retracement, the more evidence for buying interest. Therefore, we can plot the two in a plane with the x-axis being the retracement level and the y-axis being the momentum performance. The center point is the market performance. Say, for example, in the case of cryptocurrency market, the center point will be relative to Bitcoin. This approach was greatly inspired by the relative rotational graph. In this approach, we will have four main quadrants. The first quadrant will have the leaders, those issues with high momentum but with shallow retracement. There are also laggards, the ones with low momentum and a relatively deeper retracement. There are also high volatility issues which exhibits high momentum as well as deep retracements. And there are also low volatility issues, those that exhibit low momentum but shallow retracement. Moving forward, we wanted to focus on issues with high momentum with shallow retracement. Trading the wave 3 means we are trading potential uptrends. Classifying uptrends vary from one approach to another. But in Open Journal, we will confine ourselves by asking two important questions. The first question is there a trend? Identifying if the trend exists is as simple as looking at the price chart and confirm 4 points which exhibits a low, a high, a higher low, and a higher high. Although this can be useful in some cases, it is problematic for new traders because it requires experience to successfully pinpoint said parameters. The more simple and objective way of classifying trends is by comparing the moving averages in different time periods. Traders usually use 3 moving averages to screen for trend existence. In Open Journal, we will use or we advise to use the 10-day EMA, the 20-day EMA, and the 50-day EMA as a general guide. Uptrends happen when the fast moving averages aligns above the middle moving average, and the middle moving average is also above the slow moving average. In the Philippine trading community, this concept was made popular by ZFT, coined as AOTS or alignment of the stars. Sideways trends happen when there's no clear relationship between the three moving averages. The value of the 10-day EMA is greater than the 20, but 20 is less than 50, or 10 is less than 20 but greater than 50. And lastly, downtrends happen when the fast moving averages are below the middle and the middle moving average is below the slow moving average. After successfully identifying if the trend exists, the second question that should we ask ourselves is, how strong is this trend? In technical analysis literature, there is a widely used indicator to signify trend strength, the ADX. The average directional index, or the ADX, is a mathematical representation of the trend based on change in prices and volatility. We will not cover the derivation of the indicator in this module, but essentially, ADX levels can be divided into three parts. A below 20 read means that there is no trend existing, or the trend is weak. A 25 to 50 value means that there is a healthy or there is a strong trend in place. And above 50, the trend is very strong, which usually means unhealthy or exhausting and is bound to correct. In relation to our Elliott wave approach, we wanted to check for a smaller E3 pullback that has already formed a 20 to 50 ADX. The main reason for this is that we want to avoid E3s that are not uptrending, since the consolidation could extend further. We also want to avoid E3s that have 50 plus ADX already, since there's a high chance that the trend is already over. We are also subject to more volatility when trading this trend classification. Therefore, the sweet spot of our trading lies on the healthy portion of the trend, 20 to 50. In summary, we should find issues that have high momentum, issues that have shallow retracements, issues that are trending. Prices above the 10-day are generally stronger compared to prices resting above the 20-day, 50-day, and so on. We should find issues that have high trend strength but not exhausting, and issues that follow the wave characterization guidelines and rules. When used at a high level, whether you are a bounce trader, a trend follower, a reversal trader, or a swing trader, or a momentum trader, you already have an edge if you plan your trades around potential wave 3s. Trading successfully the DCS before the wave 3 will only lead to consistent profitability and survivability trading financial markets. Thank you and good luck.